NWC is net tracing changes in cash and net working capital. Cash budgeting, forecasting future sources and uses of cash, alerts for future cash needs and provide as standard. Okay, what is this sources and uses of cash? This is another area in financing. For just now, the previous session or 1 hour ago, the sources of cash, internal cash or external, the sources that you can tap for your business, we were looking at. And the uses of cash is for the operating activities of the business for the purpose of profit. 3 common steps to preparing cash budget. Forecast the sources of cash, forecast the uses of cash. Budget. Now, what is a budget in business, in finance? Budget is a proposal, is a foreseen activities, financial activities of a company. Now, for preparing a cash budget with regard to cash operations only. Okay, the sources of cash and uses of cash, calculate whether the firm is facing a shortage of cash or surplus of cash. The steps in calculating sources of cash: receivables at the end of the period, forecast sales, forecast collection, sales in current period, sales in last period, and total collection. Receivables at the end of the period, other sources, disposes of land, machineries, unused item, unwanted items. Ending accounts receivable is equal to beginning account receivable plus sales minus collections. Steps in calculating uses of cash. Payments for accounts payable. Why do you need money for the business? You may say expand, okay, but immediately you need to pay your people, whomever you have borrowed, from whom you have purchased for your business, payable from the company point of view. Labor, administrative expenses, other expenses, salary. Okay, capital expenditures, pay for long-lived assets, taxes, interest, dividends, payments. Prepare sources and uses of list each period. Determine short-term or long-term requirements. You need to put the term requirements. Is it immediate need or is it for a longer need or is it needed for one time or longer time? Dynamic matrix for financing plan. First quarter, second quarter, third quarter, fourth quarter, and finally. You know, when you prepare a budget, how much you need for the first quarter. First quarter is 3 months. Second quarter including 6 months. Third quarter including 9 months, 12 months. And the final for all the months. You notice there is a difference. 86, 80, 121, 128. See the first quarter, 80. In the second quarter, 80. In the third quarter, you require 50% more. Fourth quarter, you require 50% more than the first quarter. That is cash inputs. Now cash going out, 131, 95, 95, 93. First quarter, you require more cash to go out, payable. And the second quarter, it reduces and remains almost same, 93, 95, closer. And the cash balance. You are going to have in the first, what is in the red color here, 45 is you need more cash in the first quarter. Second quarter also you need more. When you are reaching the third quarter, you are going to have little balance. So you need to prepare your cash budget accordingly. You need to anticipate. Forecasting is one of the key areas in financial management, financial planning. So likewise for marketable securities, likewise for marketing securities. Questions to be asked. Cash or marketable securities enough or expand? Does plan change? Supposed to be change. Change current and quick ratios. Hidden cost to stretching payables. Does plan leave dynamic in good financial shape for 2005? What about long term? It's not long term, long term. So sorry for the typing error. Long term, LONG, term financing and capital expenditure. Can the firm's operating and the investment plans to be adjusted to make the short term financial problem easier? Yes, you have to work on that. One. Sources of short-term financing. Bank loan could be short-term. You can go for a bank loan because you are not committing yourself for long-term for interest payable. Bank loan, remember, it is a burden to the business in the long run. Other sources of short-term financing, secured loans. Cost of bank loan. What are the costs involved in when you go for short-term bank loan? Simple interest, discount interest, compound interest. Most likely, it is going to be compound interest, and it is you are going to pay heavily. Cash inventory management. Cash collection, disbursement, and float. Okay. Payment float. Checks returned by a company that have not yet cleared the interim period. Okay. Payment float is the interim period. Availability float. Move on. I would like to move on conveniently. The other part I have little more better version. Second part. I'm not sure. Okay, hold on. This may make more sense. Okay, that was little advanced. This picture now should summarize. This picture should summarize what so far we have been talking about. If you can capture this picture in your mind, working capital is done. What you see, the firm buys inventory, goods. Inventory is goods available in your store. Firm pays for the inventory at a particular period, and the firm sells the product in a particular period. Okay, and the firm receives payment from the customers. Firm receives payment means receives from customers. Now within this blue line, you have to pay to your person from where you purchased. You are getting money at the fourth stage, and you have to pay money at the second stage. Firm pays for the inventory. Whatever you have received, you are paying money. Let us say you are buying a product and you are selling the product after 100 days. Let us say it is 100 days. But you have to pay to the person from whom you purchased within 30 days. But you are getting the money after 100 days. That means After you pay your money, you are getting from your customers, there is a 70 days gap. There is a 70 days gap is there. And when you get the money, from the customer, it comes to your place, cash cycle, to your business. The whole thing is called operating cycle. The whole thing is called operating cycle. So now this is very simple. Formulas are used, which can be easily understood. The previous part is more colorful and little more advanced. Maybe you can have a view at it leisurely after I explain this one. This will make sense more for our stage. Inventory days to calculate inventory divided by average daily cost of goods are sold. Now, from where do we count all these things? Always fall back to this slide. Inventory days, firm pays for the inventory, firm sells product, firm receives the payment, cash cycle, operating cycle, accounting cycle, inventory cycle. Whatever the figure falls into it, you'll have to use it in the formula. That's the amount that you are going to use in the formula. Working capital is an investment which affects your business, your cash flows directly. You buy a product for 100, sell it, and you get money after 100 days, and you have to pay within 30 days. The 70 days you have to manage your cash. Mismanagement of working capital is a common cause. I can agree to that from my experience. This happens because of lack of planning, lack of knowledge, lack of planning, and lack of planning. And as the book says, it is overstocking, hoarding things in your company without realizing that it has to be sold in a later day. You keep accumulating, you end up paying your warehouse tax, warehouse rent, protecting those items if it has to be maintained in a particular temperature, again another cost. And over trading. What is over trading in finance? Before you get your inventory, you start selling the product. How can you do that? And don't have things to sell. Objectives of working capital. Okay. Why I am using this slide is another reason. In your question number 3, what are all the elements of working capital cycle? For that, this session will be more useful. And what will happen when you have high level of working capital? What will happen when you have lower level of working capital? Two main objectives of working capital management are it has sufficient liquid resources, increase its profitability. The objective of profitability is to support the primary function of financial management objective, which is shareholders' wealth maximization. We always say, yes, profit is the motive of business, but shareholders' wealth maximization takes the priority, which is longer term, and it includes financial profit. The objective of liquidity ensures that liabilities can be met as they fall due. Conflict between two objectives. Liquid assets such as bank accounts are very little return or no return, so liquid assets decrease profitability. Liquidity affects your profitability. How? If you do not have sufficient liquidity possibility, you won't be able to maintain, run, sustain your business. The, the business operations will be directly affected. Profitability is met by investing over longer term. Okay, there are business shorter term, there are business with longer term. Okay, so the longer the business exists, the longer that you have your working capital cycle, the better it will be. Trade-off between two objectives. It depends on the particular circumstances of an organization. Liquidity may be more important objective when short-term finance is hard to find. Profitability may become a more important objective when cash management has become too conservative. Both objectives are important and neither can be neglected. This picture is one of my favorite picture, how to balance the working capital between profitability and liquidity. If you hold on too much of liquid assets, it's not going to be useful. The business has to be run smoothly with an uninterrupted flow of cash coming in, cash going out, cash coming in, cash going out. The cycle. You buy the inventory, you sell it out, get the cash, and then you buy again. So this cycle has to be balanced and maintained, ensuring what's the liquidity? Ensuring current assets are sufficiently liquid to minimize the risk of insolvency. You don't run out of money. You don't run out of finance for your business. What is profitability? Increasing your rate of return, maximizing the return on capital employed, return ROCE, return on capital employed. Hence, minimizing investment in working capital. Working capital is important. Remember, working capital is important, but having too much of working capital, too little of working capital is not going to help financially in any way. Now, how much is going to be high? How much is going to be low? It depends upon the business. It depends upon the nature of the business, the function of management, and it depends upon your ability. Manufacturing company versus food retailer. Their liquidity level will be different. These two companies, manufacturing company and food retailer company, will be different. For a manufacturing company, they need to have a lot of inventories. Manufacturing companies, they need to have a lot of inventories to complete the production. Let's say produce a car. To produce a car and to produce, say, a food item. Let's say the lunch or breakfast or nasi lema or what is the favorite food? Nasi ayam. Okay. Let's say the food retailer, Nasi ayam, and manufacturing company is a Proton car company, local company. Now, to produce a car, you need to have a lot of parts. You need to have a lot of long inventory days. And for food, you don't have to have an inventory. The best example will be the malls, the supermarkets. Things come in, things go out. They need to have a very good proper inventory management. Otherwise, they will have running short of products, running short of money. In the food industry, in the shopping mall industry, they don't have to have a very big working capital. Goods come in, they sell it in 3 days, 5 days, and they sell it normally on cash basis, on cash terms. and then they can use the same cash and rotate. Whereas in a manufacturing company, it's a big business with much greater investment, and they need to have a longer and larger inventory of goods. I suppose you can picture these two in your mind. One is the food industry, or the supermarket or hypermarket or malls where they buy and sell, shopkeepers buy and sell. The other one, production of a car. Comparing these two, manufacturing company have to have longer inventory days, and they need much higher working capital. Liquidity in the context of working capital management means having enough cash or ready access to cash in hand, cash at bank, or short-term investment which you can break as you require. Cash inflows from normal trading operations, cash sales. Overdraft facility or other ready source of extra borrowing should be standby, available for liquidity to maintain your liquidity in the business. This has to be thought of. People, small business SMEs, sometimes they overlook, not that they don't want, but they overlook keeping the option for OD facilities, overdraft facilities, and because of which the liquidity is affected. Approaches to working capital. I have used the word low risk, medium risk, and high risk. A firm choosing to have a lower level of working capital than the rivals is said to have an aggressive approach, whereas a firm with a higher level of working capital has a defensive approach, lower risk approach. The first one is higher risk. That means they are having lower level of working capital. They have zero working capital or maybe 25% of working capital. Whereas in the second aspect, they are having enough high level of working capital. Effective working capital leads to cash flow. Cash flow for a business is the life flow of a human body. How important for a human body to circulate the blood through all around our body, so also for a business, the cash flow. Profit versus cash. Profit is not cash flow. Cash flow is not profit. Cash flow is the money comes in and goes out. Profit is after reducing all the expenses. Trade-off effect on the cash flow and on profit are as follows. Purchase of non-current assets for cash, it affects. Sale of goods on credit, it affects your working capital. Tax, it affects your working capital. Cash operating cycle, that is working capital or trading cycle, is the length of time of the company that takes. Okay. This is another picture which I already told you. This is another picture to remember comprehensively to understand the working capital flow, which can be used for your assignment. Okay, you may like my picture, or you may also Google and find some images, good images that you can understand, and use in your assignment. Working capital cycle is the round thing or the below the part. Complete cycle is called working capital cycle. Each have got their own days. There is no fixed rule as such how many days you should hold, how many days you should. The quicker, the better. Okay, this is the format. For a manufacturing company and for a wholesale or a retail company, see the difference. Raw materials, holding period. See, manufacturing company have to collect different parts of the components, assemble and convert into semi-finished product, and then finally finished product. Work in progress. Whereas in a wholesale store or a supermarket or a retail market, things come in, payment is paid and received, money received. Quicker, it all will be quicker. Maybe a day, maybe a few hours. Whereas in the manufacturing sector, it may take months, maybe 3 months, 1 month, maybe a year. Okay, these are all repetition. Okay. Here is a sum. Cash operating cycle. Let's read. This is an exercise of so far I have talked in the air. I have talked in the air. Now get into one practical exercise. A company generally pays its supplies 6 weeks after receiving an invoice. Note the words. Pays after 6 weeks after receiving an invoice, while receivables usually pay within 4 weeks of invoicing. 4 weeks of invoicing. Raw material inventory is held for a week. So inventory period is 1 week. Processing itself takes 3 weeks. Holding period. Finished goods stay in inventory for an average of 2 weeks. How long is the company's cash operating cycle? So you have 6 weeks, 4 weeks, 1 week, 3 weeks, and an average of 2 weeks. Now, how do we calculate the cash operating cycle for this scenario, for this problem? The company generally pays its supplies 6 weeks. This is based on this formula. Based on this formula, cash operating cycle formula. The company generally pays its supplies 6 weeks after receiving an invoice. This is the only thing you need to minus. If you notice, the payables is reduced. The rest of the things are plus, 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 plus. And then you can come out with the number, and that will be the answer. That will be the answer. Cash operating cycle answer. Okay, this is from another cycle. Okay. What is the relevance for managers? What are we to do as a financial manager, financial controller? What is your role in your company? If you are an owner, then what's the relevance for you? What you are supposed to do to improve the performance of your company in terms of working capital? If a firm has short-term financing issues, it may not survive in the long term. When managing cash flow related to operating activities, there are 3 key areas. Reducing inventory level. Do not hold it for longer days. Reduce account receivable days. Try to receive the money as early as possible. Increase accounts payable. It is important to effectively manage how much is invested in net working capital versus fixed assets. Now, talking about working capital management, you have to also touch upon fixed assets. Assets that are not going to be used. The fixed assets are not going to be liquidated soon. If you hold too much of fixed assets, let's say 1 million, and the working capital is only 10,000. It's in a car production manufacturing company. Their working capital is only 10,000. but their fixed assets are so many. What does it tell? They have produced so much, or they have invested in the fixed asset so much, they are not able to manage the working capital. It's very bad scenario. It should be in proportion to your fixed assets, because in business fixed assets does not immediately bring in return, but definitely it brings in the longer term. But in the immediate term, you need working capital to continue in business. So that's all I have for